and welcome to this special show. Today we're in conversation with Ritesh Tiwari, the Chief Financial Officer for Hindustan Unilever, and we're here to talk about consumption and the FMCG industry. We're going to be talking about the recovery in consumption, rural demand, and what each category for HUL has been performing like. Ritesh, thank you so much for speaking to CNBC TV18, and what a pleasure to have you in one of these very rare interviews. To start off with, we've seen a recovery in volume, even though it's just starting off. Even from a margin point of view, growth is also slowly coming back, is what you and all the other consumption companies are also saying. I wanted to understand from you then, is it safe to say that going forward, we're probably coming back to a normal growth cycle for HUL and for the FMCG industry?
Yeah. So let me just add, Shilpa, 2-3 different perspectives. For FMCG business overall market, long period, look at last 5 years, 10 years, 20 years, growth typically comes 2/3 from volume and 1/3 from price.
Yeah.
Given the amount of inflation that we had seen for last 1.5 to 2 years' time, growth has been led by pricing. What will change going forward as commodities are tapering off? We are seeing sequential declines as well in many large commodities. Price will taper off, and going forward, the growth will be volume-led.
Right.
Now, what is happening in this transition, if I look at last year, financial year 22-23, for FMCG industry as a whole, industry grew at 8% with a negative 4% volume, which means there was a 12% price increase which was there. If I look at last quarter, March quarter, again FMCG market growth, market grew 11% with flat volumes. So exactly to your point, volumes have recovered from the lows which we had at the peak of September quarter last year to the latest quarter market data showing as a flat volume.
Yeah.
Within that, if I tease out urban and rural, within the flat volume, urban is growing by 3%, rural is still declining by 3%. But the way we see this point in time, that the entire slowdown that the FMCG had seen, especially in volume, that is bottoming out. Rural has also substantially recovered compared to what it was at a very high single-digit volume decline at one point in time. It's at 3%. So definitely we do see that the overall slowdown has bottomed out. The inflation reducing is indeed helping market growth at this point in time.
Right. The first point that you made on the rebalance of price versus volume, that's actually my next question. Earlier, traditionally, I think about 65 to 70% always came from volume growth.
That's right.
When do you think going forward will we see this sort of a balance coming back? Not a balance, but this ratio coming back where about 1/3 is price, but it's largely led by volume. Yeah. Is it easy to say when?
Yeah. So good news which has happened that commodities from their peak have tapered off materially in some large spaces like palm oil, crude oil. Indian rupee has also been extremely resilient and firm this point in time. So we've not seen sequential inflation coming in, which is why, though the cumulative inflation has been significant, if I look at Hindustan Unilever, last 2 years we've seen 30% inflation. In a bucket of 2 years, that's completely unprecedented.
Yeah.
Now, this inflation is not going further. In fact, we are seeing some sequential coming off of few commodities. So the way we see going forward, the balance, as I mentioned earlier, we will start moving to a period where growth will be volume-led. Now, I don't see this point in time price getting in mix in terms of adding to the total growth. As you mentioned, 2/3 volume, 1/3 price. We spoke about it in the past. I don't see a component of 1/3 price into play for next few quarters at least.
Okay.
It will be by and large volume-driven conversation going forward. So it will be volume-led growth. And why I say that? Because number one, we had seen, as I mentioned, cumulative 30% inflation. That is coming off. But the impact on consumption is still there. When look at a consumer who's buying, when we end up making a price decrease of our products, it takes a little while before consumer gets to benefit that price decrease. But there's pipeline stock that retailers will have, consumers in their own house will have old price stock. There's always some lag between a price reduction benefit goes on in terms of consumption benefit a consumer takes, which is why there's some lag in volume recovery that happens. Second, as I mentioned, the cumulative inflation is still high.
Yeah.
Over a 2-year period. That still bites the consumers. The fact that it is not further inflating is really helping. So these two elements put together, in our view, typically volume recoveries will take some time, but growth will still be volume-led for next few quarters going forward.
So you're saying next quarter onwards, we can see volume-led growth already?
Of course, there'll be a balance for one more quarter, June quarter, but definitely as we move forward towards later part of the financial year, it will definitely be a volume-led business that will happen. It will take a quarter or two for it to further stabilize from the peak of 7% that we've seen in the recent period, but you will see that price growth tapering off.
Right.
So yes, in next couple of quarters, you will see volume leading price in terms of total growth composition.
So second half of this fiscal year.
Indeed. Second half of this financial year, you would expect growth to be volume-led.
Right, great. And, in terms of rural also, we're seeing some recovery. The rural slowdown has bottomed out. That's what even Nielsen's data is also suggesting. But, we've had a heat wave, we've had unseasonal rains. We've seen that impact on farmers in certain states, especially even in Maharashtra, if you see, there was a lot of crop damage. And also this time, monsoon, there is still a chance that it could be deficient. So do you then see, how do you then see the rural growth panning out in the next couple of quarters? Do you think it's going to continue remaining under pressure?
So there are macro factors overall which are helping the rural consumption story. Of course, there's another important factor which is inflation. The point that we just spoke, inflation now is coming off from its peak. That is one more factor which is helping rural recovery. And that's the point we mentioned, that the rural slowdown is bottoming out. Yeah. From here onwards, few variables very important to see. What will now start triggering better version of growth in rural areas. So I guess we got to see how El Nino, the quality of rainfall, the quantity of rainfall, and the resilience of the rural infrastructure that we have in agriculture all play out, and we will hence have a little better read in few months' time what happens in terms of overall impact to agriculture, weather and monsoon related. In the times that we're in today, when disposable income have got hurt, of course the poor have got more hurt. And which is why at this point in time, urban markets are showing better resilience compared to rural market.
And, want to talk a little bit about inflation and related to that. Now, with inflation cooling off, last quarter we've seen some grammage increases and price cuts that have been taken. Is it safe to say that price increases are behind us? And will we see more benefits of inflation and the commodity prices cooling off being passed on to consumers?
At an aggregate level, answer is absolutely yes. So let me just give 2-3 category examples, Shilpa, out here. Where we saw highest amount of inflation impact was in skin cleansing, the soap business. We saw second important and large impact coming in laundry business because of crude oil. And I would say +1, and the reason I'm saying +1, I'll come to it, which is hair care, where same palm oil, derived alcohol and derived basically SLES goes in making shampoos as well. So we did see impact coming on hair care as well. Now there's a meaningful correction which has happened in skin cleansing and in laundry in terms of commodity. And which is why in these categories we have taken price cuts. Equally, in many places we have done volume increase, either giving a soap free with a bundle of soap or adding more grammage to an existing soap, or for that matter adding more powder to a pouch of laundry. So that has happened. In terms of hair, when you look at bottles, hair bottle prices have been intervened. We have decreased prices. The net price the consumer pays for buying a shampoo bottle, we have intervened in that space. So consumers have seen benefit and advantage. As I mentioned, it's always a trade pipeline, but they have seen advantage benefit coming in. There are very few elements of the portfolio where we have done price increases. That is limited, I would say, to a portfolio called HFD, by and large, health food drinks, where milk prices, cereal, barley, those materials, soft commodities as I call them, agri materials, we have seen prices of those commodities going up. And hence we have taken price increases in that.
I want to really understand, are you looking at passing on more? Can we expect more price cuts going forward?
Large part of price cut, I would say we have started invoicing, we have put in the market, but as I mentioned, it's always a trade pipeline. By the time consumers experience that, it takes few more months.
Correct.
So we have done large part of the price decreases because commodities have come off, but consumers should take, in my view, a few more months for them to fully experience the price cuts that we have done.
Right. So consumers will start seeing a slight reduction in prices going ahead, definitely. Right. What's the margin expansion outlook also looking like now? Is it safe to say that the worst of margins is behind us? And in that sense, what's your outlook on, operating margins going ahead, and also for gross margins? Do you think we'll reach the 50% plus levels in the next 2 to 3 quarters?
Yeah. See, Shilpa, margins, there are different kinds of margin which are relevant to focus on depending upon the economical cycle and commodity cycle that we are in. At this point in time, the most important element of margin is gross margin. Yeah. Which is simply your sales minus the cost of making materials and products. That's the gross margin. And then, of course, from that you reduce your overheads, your A&P expenses to come to EBITDA, for example. At this point in time, the focus remains on gross margin. If I talk about Hindustan Unilever, in last couple of years' time, given the high amount of inflation in last 2-3 years time, we have dropped 600 BPS off our gross margin. This 600 BPS gross margin got dropped because of the point I mentioned earlier, cumulatively last 2 years, 30% inflation in commodity cost. Against that, we took 18% price. So 12% price versus cost gap. That had a tell on our gross margin. Now, good news is with a good job done continuously in the business on savings, driving savings across all the lines of the P&L, and commodities coming off. In the last quarter that we declared results, we had 9% net material inflation, we had 7% pricing. So a more than 1,000 BPS of price versus cost gap came down to 200 BPS of cost versus price gap. Our own gross margin, which had taken us 600 BPS hurt, has improved in last 2 quarters by 300 BPS. So almost half of the total margin decline that we had seen has come back, 300 BPS. Further, of course, job to be done in gross margin, which is why gross margin becomes an extremely important margin line to focus on at this point in time on the business cycle.
Right.
Once gross margin recovers, the first job to be done is to keep investing behind competitively on advertising and sales promotion. If you see again sequential last 2 quarters, we have added 160 BPS more investment in the lines of advertising and sales promotion. A, because the media heat is going up, and of course, at very high inflation levels, the whole industry basically was making choices of where to put money. And hence, the first job at Hindustan Unilever that we focused on is to give the right price-value equation. This is where the investment goes. And the second investment goes is in terms of A&P. And which is why, as mentioned, 160 BPS we did increase in last 2 quarters alone. And then after that, net margin becomes a consequential conversation. You drive the right amount of gross margin, invest competitively behind A&P, and of course, net margin is an outcome. Our margin where we are today, even if I look at last few quarters, more than 23%, we do believe it's a very healthy set of margin. And at this point in time, the focus will be volume growth, the focus will be gross margin, focus will be maintaining competitive price-value equation, and focus will be investing in advertising sales promotion. And we've spoken consistently in the past as well. Our principle for A&P is share of voice ahead of share of market. That principle remains across the business cycles.
Right. But I'm still trying to understand like a rough timeline if we were to look at, while I understand the current, you feel like the current levels are healthy, the 50% plus, do you think it's achievable given the trends that we're seeing currently?
50% meaning the gross margin?
Yeah, at the gross margin
level. At the gross margin level. Absolutely, yes.
In the next 2 to 3 quarters?
No, that, how much quarter it takes is a point of conversation. Remember, when you end up doing price correction, that impacts the line of gross margin. And hence the price value equation for next few quarters, it will remain volatile across commodity categories and hence across product categories that we end up selling. But yes, everything else being equal, we would love to go back to that level of gross margin level